JD, we've mentioned your little financial article, Reading Addiction, which is extremely beneficial for this little project we've got going on, mate. A couple of articles caught your eye, a bit of a macro and investment landscape update. What caught your attention?
Yes, I think it might actually pay off. I think there's been some really interesting movements in resource project financing over the past few years that I sort of want to unpack with you guys. We'll start by just talking about how projects ideally get funded. So you'll have a team of geologists and exploration managers, and they'll go out and they'll have an anomaly that they'll test. They might have to go to the equity markets and raise some funding. And in an ideal world, they'll turn that into a resource, which will become an ore reserve. And that all happens while the process is being done from scoping study to pre-feasibility study to the DFS. In the latter stage, in the DFS, they'll start talking with financial institutions. They'll start to come up with an idea of how they're going to fund that project. And just to quickly recap, project finance, which is a common method, is where companies will raise debt and they'll use the asset as collateral, not the company, because essentially the company's only asset is the project. So this is where the articles and developments we've seen over the past few years start to get really interesting. A lot of banks and the big superannuation funds across Australia previously funded a lot of these projects. So they would have teams of geologists and resource valuation experts, as well as mining engineers and so on, who would assess the risk, kind of like what Travie touched on before, where they need a specialised skill set, in that case in REEs, to assess the risk and make sure that they can get their capital back, their principal and their interest repayments. So we've seen Alex Dorsch today highlighted that most super funds aren't investing, and if they are, they're just passive. There's an anomaly. AusSuper have stuck with it and they've made some good investments in the space, but
Hoover House. So they've obviously seen some benefit in Gwalia and Ulysses.
Yeah, that's right. But a number that really stood out to me was that the big four Aussie banks have reduced their exposure to the resources industry by $25 billion between 2015 and 2022.
Wow.
So I think there's a few sort of takeaways. This funding process does sort of follow the mining cycle. And as we saw, commodity prices really drop off between 2016, 2019. It's natural to expect that the funding and the loans would drop off as well. It's also worth highlighting that a lot of the majors are quite cashed up at the moment. The likes of BHP, Rio Tinto, Fortescue have made a lot of money in iron ore, so they don't need to go to the banks and take out loans. But I think the key highlight of this and what the trend really means is that we're going to see a lot more offtake funding. We've seen this a lot in the lithium space, where battery makers will pay the company to help turn that resource or reserve into a mine. And in the process, they'll secure the product for their production. We'll also see offshore banks come in, Canadian banks, American banks, banks from Asia come in and try and finance these projects, as well as government lending agencies, a lot more equity financing. And lastly, something I think we'll see a lot more of is M&A and joint ventures with the majors who have cash coming in and helping get these projects that we need to reach these energy reduction and emissions reductions goals into our batteries and so on for the future.
So gold, do you reckon gold is the one that's probably going to attract the most attention of banks and super funds compared to, because it doesn't require an offtake?
I think there's quite a big ESG component to this. So we saw this massively over the past few years with coal. That was a commodity that a lot of banks stopped funding first. And we might see it also in the oil and gas sort of space, where these banks will face reputational risk and they'll think twice before funding these things. So if they were to invest, I think they might be much more inclined to pick copper assets, nickel assets, lithium assets that they can tell their stakeholders have a good environmental impact.
So, but how does that work? Because a lot of those nickel and copper, all the base metals and battery metals all require, they seem to be all heading towards offtake partners as the funding rather than going to banks. What's your take?
Yeah, and I think that's a direct result of the banks losing their expertise and their experience in the space and getting rid of the geologists and the valuation experts, that they're not comfortable anymore making those loans. they don't have capacity to do it.
Banks will typically outsource the technical evaluation to an independent technical expert to sign off on some of these elements, and that tactic has brought them varying degrees of success in the past. Quite often, some high risk projects have backfired on them where the lender doesn't even get the debt back.
So where's the bank putting all their money at the moment then? If they're not putting it in mining, where's it gravitated to in that period? Everywhere else.
Look at Silicon Valley Bank, mate. It went into bonds that have been mispriced horribly.
Yeah, true. Oh, let's hope they. I don't think the banks are going to put it in crypto. God.